And I personally believe that there will be a lag in psychology from a psychology of boom to a psychology of caution. By the way, I'm not calling for the Greater Depression. I'm not calling for the end of the US dollar. I'm not doing all that doom and gloom stuff. All I'm saying is that there is going to be a reckoning as a consequence of the obligation that our society favors. And that reckoning, I think, almost necessarily results in the continued and accelerated depreciation of the purchasing power of the US dollar, and increasingly, too, a recognition of the benefits of gold, a recognition that we last saw to this extent in 1970 to 1982, but we also saw in fairly dramatic form in the period 2000 to 2012.
In the Fed's recent move, we're facing a major disconnect. We're told the economy is thriving, so why the sudden need for a 50 basis point rate cut? Rick Rule breaks it down, highlighting how the real inflation rate is closer to 7.5%, not the 2.6% the government reports. That means even with a 4% yield on US Treasuries, you're still losing 3.5% in purchasing power annually. As the Fed cuts rates, it accelerates the dollar's decline, putting your savings at even greater risk. Rule draws a parallel to the 1970s, when inflation wiped out over 80% of the dollar's purchasing power in just 11 years. Gold surged from $35 to over $800 per ounce in that period, and we could be seeing the same setup today.
I think in the near term, and I define the near term as a year, gold. Uh, Gold, in my experience, has done particularly well when people are concerned about the maintenance of purchasing power in their domestic currency. Uh, this Fed decision is really interesting. We're told we have a great economy, and the equities market would suggest we have a great economy. If we have a great economy, why do we need a 50 basis point rate cut? Uh, that's of interest to me. A broader topic, I think, Michael, around gold is the fact that if you believe, as I do, that the gold price does well when people are concerned about the maintenance of purchasing power in fiat denominated instruments, let's do a little bit of arithmetic. The government would have you believe that inflation, their measure of the deterioration of the purchasing power of the US dollar, according to the CPI, is cruising along at 2.6. If you believe that, earning 4.2, 4.3, or now 4 in the U.S. 10-year Treasury isn't a bad deal. You get paid 4% real yield in a currency depreciating by 2.6% a year. You get a positive real yield. I don't believe those numbers, Michael. I do a thought exercise every year, and I have for 6 years, around the pricing of the basket of goods and services that I consume in my life. The government, when it's inconvenient, doesn't include food or fuel. Unlike you, Michael, I'm not on a fast. So the price of food is of some import to me. Importantly, the government number in the CPI doesn't include the cost of government itself, while tax is usually the largest component of every household budget, every working family in the United States. If you believe, as I do, that the deterioration of the purchasing power of the US dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year Treasury, on your deposit products, in a currency that's depreciating by 7.5%, means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. Cutting the reference rate, cutting the Fed rate, cuts the yields on other savings deposits, while at the same time likely increasing the deterioration of the currency in real terms. And I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market. I would note that I'm a credit analyst, not a social psychologist. So my answer is going to be necessarily dry. I came into the business in the decade of the 70s, and the circumstance that confronts us now confronted us in 1968 when I was a little too young to understand it. But it was pretty clear after having fought the war in Vietnam and the war on poverty that we had more obligations as a society than we could service. It became fairly obvious, too, that we couldn't raise tax to cover the net present value of our obligations. So, what we did in the period 1970 to 1981 is that we reduced the purchasing power of the dollar through inflation by over 80% in 11 short years. The consequence of that is that the gold price, of course, went from a price controlled $35 an ounce, pardon me, to a price in excess of $800 per ounce. What's germane to the question is that the writing was on the wall around inflation beginning in 1968, but it didn't become a matter of popular concern until 1972 or 1973. If you dial back to that circumstance, if you dial back to those days, we had experienced very, very, very buoyant economic conditions from the end of World War II, say 1946, all the way through 1968. The Nifty 50 is an example, the wonderful growth of American hegemony around the world, the strength of the US dollar, and people were conditioned to be optimistic. I would suggest that we have lived through an even longer and even more beneficent circumstance from 1982 to 2022. Wonderful boom in, wonderful strength in the US dollar, wonderful equity markets, wonderful bond markets, a lot of animal spirits, people being trained to buy the dip, people not being afraid. I personally believe that this beneficent epoch that we enjoyed, this 4-decade epoch, came to an end in 2022. And I personally believe that there will be a lag in psychology from a psychology of boom to a psychology of caution. By the way, I'm not calling for the Greater Depression. I'm not calling for the end of the US dollar. I'm not doing all that doom and gloom stuff. All I'm saying is that there is going to be a reckoning as a consequence of the obligation that our society favors. And that reckoning, I think, almost necessarily results in the continued and accelerated depreciation of the purchasing power of the US dollar, and increasingly, too, a recognition of the benefits of gold, a recognition that we last saw to this extent in 1970 to 1982, but we also saw in fairly dramatic form in the period 2000 to 2012. Well, price controls really has a track record unblemished by success. If you look back to markets where they had price controls, what you ended up having was a supply control. You also had a diversion of revenue from the people who could increase supply, which is to say private industry, to those who always constrain supply, which is to say the US government. It may be that price controls become popular again. I don't know. My hope is that an examination of history will cause even our political elites to be less stupid in the future than they have been in the past. I've never seen price controls work. Let's look at New York City, the consequence of rent controls. Slums, underinvestment in rental construction, a lack of availability of rental accommodation, a track record, as I say, unblemished by success. Successful, of course, for those people who were able to obtain rent-controlled units in the 1970s and 1980s and enjoy substantially below market rents today at the expense of the broader community. Price controls never work. Markets always work. The cure for low prices is always low prices. The cure for high prices is always high prices. But markets are messy. They take time. Markets have victims. Markets have beneficiaries. The victims are always covetous of the beneficiaries. The victims are also more numerous and they vote.
Now that you understand the serious implications of the Fed's recent moves and the potential reckoning for the US economy, you're going to want to dive even deeper. The next video on this channel covers the critical strategies you need to protect your wealth and navigate these uncertain times. Make sure to check it out. It's essential if you want to stay ahead of the curve and make informed decisions for your financial future.